All right, let's get the read on what's happening now with the Federal Reserve, too, because this sell-off at its core has everything to do with rising interest rates. Now, a lot of people, and David and I were joking about this earlier, look at this back up in rates and say, gosh, we can remember when rates were certainly a lot higher, but it's what you get used to. And around a 3 1/4 handle on a 10-year Treasury note, that does represent the highest we've seen on that in about 7 years. And it jars a lot of folks who have gotten used to sort of nothing like it. To CNS News editor Terry Jeffrey, joining our esteemed panel here. Terry, what do you make of that? I mean, I can remember, and I joke about enough here that my crew is tired of hearing it. That was kind of what my wife and I were paying per day for our first mortgage. We were married back in the 1880s. It's a long time, but that, you know, it's what we get used to, and a lot of people are not used to that, and it does force a lot of people who heretofore might have qualified for a mortgage out of the running for that mortgage. So I get that, but is it a big deal? Will it get worse of a deal?
Well, it can get a lot worse, Neil, and I remember that era too. But this morning I just went back and did a little research looking at the average interest rates on Treasury securities. And if you look at the end of fiscal 2007, September 30th, 2007, just a few months before the Great Recession started in December 2008, the average interest on Treasuries then was 5%. At the end of this fiscal year, it was 2.494%. But the difference is the amount of debt the government has accumulated in the intervening years. 8 of the last 11 years, the government has borrowed $1 trillion or more. Fiscal 2018, we borrowed $1.27 trillion. We now have $15.7 trillion in debt held by the public. If we see interest rates go back up to 5% over the next 4 years, and the government keeps borrowing at this rate, we're going to have $20 trillion in publicly held debt. The government's going to have to spend $1 trillion on interest. And we could be in a situation where the federal government is running a $1 trillion annual debt, borrowing $1 trillion, turning around and handing that $1 trillion out in interest to the people it borrowed money from before.
And we haven't even gotten there into all the states and municipalities that if you add up their liabilities, I mean, would double that 15, 16 trillion. So it doesn't take much of an uptick in rates to do that. Now, I was raising this with David and the gang during the break here about how much can be renegotiated. I mean, how much you can sort of refinance, if you will, if you're the federal government, take some longer term maturity, shorten them out, or vice versa. Do we have any wiggle room on that?
You know, and here's another thing that if you look at the structure of the debt, you were talking about the short-term Treasury bills earlier. We have $2.2 trillion roughly in those short-term Treasury bills mature in a year or less, and there's only about 1.37 in long-term bonds. So most of the publicly held debt is in bills and Treasury notes. So it's like an adjustable rate mortgage on the federal government. When the interest rates start to spike, the impact on the average interest rate that the federal government is paying on the debt is going to rise much faster because so much of that debt was sold for short periods of time in order to keep the interest rate down.
Now, you have to differentiate between short-term rates over which the Federal Reserve has some control and longer-term rates that are really in the hands of the markets. Now, the markets seem to be saying they anticipate short-term rates going still higher and that the economic activity alone will justify rates going higher. Do you subscribe to that? Because that's a trend that could go on for a while and then take rates prohibitively higher.
Well, I think the bigger worry is the structure of the fiscal actions of the federal government on a year-to-year basis. Habitually, we have a government that is spending far more than it can bring in revenue. If you tried to balance the budget this last year, for example, we have a little bit over $4 trillion in spending. We're probably going to have a little bit over $3 trillion in revenue. You would have to increase tax revenue by 1/3 to balance the budget. We have an all-Republican government. They're not talking about balancing the budget. They're not focusing on this debt problem. So what's going to happen is the level of debt is going to increase. So if we get to a point where interest rates really spike, quite frankly, we're going to have a financial crisis. The government's not going to be able to deal with it. By the way, the Federal Reserve is still the #1 owner of debt. They bought up all that debt during quantitative easing. They still hold that debt. The Federal Reserve has more debt than China. China has essentially stopped increasing its debt holdings. So we have these two entities out there, China and the Federal Reserve, that are the biggest creditors of a government that is running an annual debt of $1 trillion.
Well, you've done it again, Terry. I was looking forward to lunch, and now a little less so.
Sorry about that.
If you